Most people hear Iran escalation and expect one thing: oil up, gold up, Bitcoin up. That's the story. But look at the scoreboard right now. Gold is up about 2%. Silver is up roughly 8%. Bitcoin is down around 3%. That seems backwards. It's not backwards. It's liquidity. I'm Tim George. I use an AI avatar to keep these macro insights coming to you daily. But every word, every chart, every data point, that's 100% me. Here's what we can say without guessing. Major outlets are reporting strikes and retaliation activity across the region today. I'm not here to cover politics. I'm here to cover what geopolitics does to your money. Because what you're watching isn't just a headline. It's the market's risk switch flipping in real time. And the key insight is simple. In the first phase of a shock, the market doesn't buy the best asset. It buys cash. Now here's the part that matters. This exact reaction, gold up, Bitcoin down, is something I warned about on February 20th when war with Iran was trending. And I'm going to show you the exact line. In a crisis, selling is no longer a choice. It's a requirement. Think about all the leveraged players in the market: hedge funds, institutional investors, and even retail traders on margin. When the value of their assets falls, they get the dreaded margin call. Their broker demands more cash. But where do they get cash in a liquidity crisis? Their credit lines have been pulled. They have only one option: sell assets. And what do they sell first? They sell what's liquid. They sell Apple. They sell the S&P 500. They sell Bitcoin. They sell whatever they can sell. Here's the sequence to watch, and you'll see why this isn't really an oil story. Shock headline hits. Risk managers tighten. Traders de-risk. Spreads widen. Cash becomes the asset. Margin calls don't care about your thesis. They care about your collateral. Forced selling targets the most liquid stuff first: index futures, mega cap stocks, Bitcoin, anything with a bid. That's how you get the paradox day. Gold up, silver ripping, Bitcoin down. Silver is a special case. It's not just a monetary metal, it's also an industrial input. So in a fear spike, silver can catch the gold bid plus the hard asset scramble. That's why it often moves harder than gold in the early phase. Bigger engine, more volatility. The next phase is what matters, not today's candle. If this escalates further, I'm watching 3 signals. Number 1, oil shipping disruption risk. Not the price on TV, the plumbing around it. Insurance, shipping, settlement. Number 2, dollar funding stress. When banks get defensive, global dollar credit tightens. Number 3, Bitcoin's correlation. If Bitcoin starts rising with gold after the first liquidation wave, that's a regime shift. That's Bitcoin behaving like a hedge asset, not a risk asset. This isn't advice, it's mechanics. Don't make big decisions in the first emotional 12 hours of a headline. Instead, check your leverage. Margin is what turns volatility into permanent loss. Know where your liquidity is. Real liquidity, not a promise. Decide ahead of time what you'd add on weakness and what you'd never sell into panic. Because in a real liquidity event, the worst mistake isn't being wrong on price, it's being forced to sell. If you want the full framework, the sequence of failure, and why liquidity breaks before headlines catch up, that February 20th video lays it out step by step.